Welcome to our video about the difference between trading and investing. When it comes to managing our finances, there are many different strategies we can use. Two of the most common approaches are trading and investing. However, these two strategies have significant differences that can impact your financial goals and risk tolerance. In this video, we will explore the key differences between trading and investing, including their time horizons, risk tolerance, return on investment, and approach to analysis. We will also discuss the pros and cons of each approach, and how to choose which one is right for you based on your investment goals and personal preferences, whether you are an experienced investor or just starting out. Understanding the differences between trading and investing is essential for making informed investment decisions that align with your financial goals. So sit back, relax, and let's dive into the world of trading and investing. Before we start, please like the video, subscribe to the channel, and press the bell icon to be notified of future uploads. What is investing? Investing is the practice of buying and holding assets for an extended period of time, with the goal of generating a return on investment over the long term. Investors typically look for assets that have the potential to appreciate in value over time, such as stocks, bonds, and real estate. The primary goal of investing is to generate a passive income stream, either through capital gains or dividend payments. Investors tend to take a buy-and-hold approach to their investments, holding onto their assets for many years, even decades, in order to maximize their returns. This approach is based on the belief that the markets tend to rise over time, and that investors who hold onto their investments through the ups and downs of the market are more likely to generate higher returns in the long run. What is trading? Trading, on the other hand, is a short-term strategy that involves buying and selling assets frequently in order to profit from the price fluctuations in the market. Traders look for assets that are undervalued or overvalued and try to buy or sell them at the right time in order to maximize their profits. Unlike investors, traders are not focused on generating a passive income stream over the long term. Instead, they are focused on generating quick profits through their trading activities. Traders use a variety of different strategies and techniques to analyze the markets and identify trading opportunities. Some traders rely on technical analysis, using charts and other tools to identify trends and patterns in the market. Others use fundamental analysis, analyzing company financials, economic indicators, and other data to make informed trading decisions. Some traders also use algorithmic trading, using computer programs to execute trades automatically based on predetermined criteria. Key differences between trading and investing. Number 1. Time horizon. The primary difference between trading and investing is the time horizon. Investing is a long-term strategy where investors buy assets with the intention of holding on to them for many years, if not decades. The goal is to benefit from the compound growth of these assets over time. Investing is not concerned with short-term price fluctuations, but rather the overall growth potential of the assets. Trading, on the other hand, is a short-term strategy that focuses on buying and selling assets within a short period of time, often hours or days. Traders aim to take advantage of market inefficiencies and price movements in order to make quick profits. Trading involves actively monitoring the markets, making decisions based on technical analysis or news events, and being comfortable with taking risks. Number 2. Risk tolerance. The level of risk is another major difference between trading and investing. Trading is generally considered a high-risk strategy due to the short-term nature of the approach. Traders must be comfortable with taking risks and accept the possibility of losses. Traders often use leverage or borrowed funds to amplify their potential returns, but this also magnifies their potential losses. The goal is to generate higher returns quickly, but this comes with greater risk. Investing is a more conservative approach with a lower level of risk. Investors tend to invest in assets that have proven track records and are more likely to appreciate in value over the long term. This approach may involve diversification or spreading investments across multiple assets and asset classes to reduce the overall risk. The goal is to generate steady returns over time with lower risk. Number 3. Return on investment. The returns generated by trading and investing differ significantly. Trading can generate higher returns in a short period of time, but it comes with greater risk. Traders must be prepared for the possibility of losses, and it is not uncommon for traders to lose money on trades. However, successful traders can earn significant profits in a relatively short amount of time. Investing tends to generate more modest returns over a longer period of time, but with less risk. The goal of investing is to build wealth over the long term, and this can take many years, if not decades. However, the overall returns can be significant, especially when compounded over time. Number 4. Approach to analysis. Investors and traders use different approaches to analyze the markets and identify investment opportunities. Investors tend to use fundamental analysis, which involves examining the financial statements of companies, industry trends, and macroeconomic factors to make informed investment decisions. The goal is to find undervalued assets that have the potential to appreciate in value over the long term. Traders, on the other hand, use technical analysis to study market charts and data to identify short-term price trends and patterns. Traders often use computer algorithms to execute trades automatically based on predetermined criteria. The goal is to identify short-term opportunities to buy and sell assets to make quick profits. Which is right for you? Choosing between trading and investing depends on your goals, risk tolerance, and investment philosophy. If you are comfortable with taking risks and are looking for short-term gains, trading may be a viable option. However, if you prefer a more conservative approach with lower risk and are willing to wait for the long term, investing may be a better fit. In conclusion, trading and investing are two distinct approaches to managing your finances, each with their own benefits and drawbacks. Whether you prefer the potential for quick gains through trading or the slower but steady returns of investing, it's important to consider your financial goals, risk tolerance, and time horizon when making investment decisions. We hope this video has helped you gain a better understanding of the difference between trading and investing, and has given you the tools you need to make informed investment decisions. As always, it's important to do your own research and consult with a financial advisor before making any investment decisions. That brings us to the end of this video. If you enjoyed this video, please leave a comment and let us know. And don't forget to like and subscribe to stay up to date on all of our new content. See you soon. Thanks for watching.